I V Vaidyanathan, Managing Director and CEO of IDFC First Bank now joins us. Mr. Vaidyanathan, good morning. Thank you for joining us. We got you at a time when things are indeed looking upbeat. The budget has surprised us. Growth is back from the throes of pandemic to a complete level of excitement. Things indeed are looking up, aren't they?
No doubt about it. I think that if you see all indicators that are coming across all sectors, whether FMCG or sales of tractors and vehicles, and everything is all looking up, I think.
Things are looking up for IDFC Bank as well. Things are looking up on the retail front. However, some would argue that the challenge is the historical challenge which you have in the MSE and SME book. So while retail book is growing, how do you plan to address the other aspect?
No, actually there is no challenge in the MSE book. The challenge was actually the large corporate exposure, infrastructure exposure. So our infrastructure exposure at merger was about 22,000 crores. We are very aware that infrastructure has to come down because infrastructure, as you know, Nikunj, you talk to people all the time, is so it has its own challenges in terms of how it can get mired in some issue or the other. So that book we have brought down to 11,000 crores now. So our game plan is next maybe 2 or 3 years, we will bring it down to as good as nil. And that is a big one. On MSME and on consumer, frankly, that is our stable business and it is a staple business, and that is doing fantastically well.
I want to understand the CASA side of your business. The fact that you are offering the best rates in the industry has really helped you to get a lot of low-cost deposits. You've been successful in getting low-cost deposits. What happens next now? Obviously, you can't pay such high rates for savings.
Two things here. First of all, we had a historical borrowing rate because remember IDFC Limited was at DFI and had borrowed at about 8.5%, and even Capital First and NBFC had borrowed around that rate. So we had a large borrowing at that rate. So we paid 7%. 7% was a good rate compared to 8.5%, and we kept swapping that money. But that's then. The important thing is that our incremental flow from the customers on CASA has been like phenomenal, and our CASA rate is now touched 48%. So obviously at 48%, we are feeling very, very comfortable. Our liquidity in the bank is like 17,000 crores as we speak today at the time we file the quarterly results. So obviously we don't need to pay 7% anymore. So we have brought down our rates to 6%. But frankly, we are a very customer first organization. Even at 6, we are among the let me say that we are among the attractive rates in the market today. And by the way, the 6% change will also increase our net interest margins.
Fair point. I'm curious to get your reaction on a Morgan Stanley report dated 31st of December, a day before budget, when you came out with numbers. Headline beat, core miss. Treasury gains drove the beat, but else profits were near zero. Stress assets ratio is at 13% and the coverage is 46%. Basically, they're calling you one of the most expensive banks looking at the underlying growth.
See, they have always called us the most expensively overvalued bank, if I may, something of that term. Now, actually, in this report, they made a mistake. I think it's an honest mistake. I don't think there's malice behind it. But they made a mistake whereby they added the bonds exposure and non-funded exposure on the numerator, but in the denominator, they forgot to add that. So if you net off it, actually the numbers are much lesser than what they represented. But I think it's a genuine mistake. They'll hopefully fix that. But I think stepping away from that, they have actually never got us wrong. You go back and see the track record. They have always been wrong. So how do you deal with someone who's always been wrong about you? So I'm going to leave it at that. Let me just say that one more thing, by the way, before I sign off. On this issue, they are just being very mathematical about us. But how do you value a phenomenal intellectual property the bank is building? How do you value the fact that this bank has shown the capability of growing from 100 crores to 30,000 crores, from 30,000 crores at merger become 60,000 crores. We are now projecting to be 1 lakh crore. That sort of a growth on the retail side, no valuation, they can't see it. They can't, they can't see the fact that NIM has grown from 1.5%, 1.6% to 4.6%. They can't see PPOP has moved from 30 crores to pre-merger to 500 crores, even without treasury. They just can't see any of these things. They're just going on about one issue that, look, your ROE is low. Fine, our ROE will come. It will come. We're building a good bank. ROE will come. It will be a mid-teens, will be a 18% ROE bank, in my opinion. And they will reverse their opinion at that time.
So when do you think your ROA, I'm going to add one more bit here, ROA and ROE will be in and around industry averages?
Definitely we're getting there. You see, let's just get back to the core. The core is the ability to lend in a safe manner, in a risk-adjusted manner, and that capability we have demonstrated quite a time. In Capital First, the NIM was mostly 9%. In this bank, our NIM has already touched 4.6%. So let me say, on the retail side, just imagine now we're going to borrow money at 6% incrementally because the saving rates are 6% at the peak. We're going to borrow money at 6%. Our lending is on an average around 15-ish%, but we lend anywhere between 9% to 20% depending on product segment. You borrow at 6, lend at 15, you have to make money. It has to become ROE accretive. Forget, over time, infrastructure problems will go away. Over time, some of the corporate loans issues will go away. They'll all go away. It's a matter of time. They've already been going away. So when this book superimposes that book, and by the way, risk adjusted, our credit loss used to be 3%. Our incremental projection is only 2% because our credit quality is improving. So if you lend at 15, 16, you have a 2% credit loss. There's a 14% risk adjusted money. You're borrowing money at 6. It's pretty plain. It has to make money and it has to be ROE positive. So my sense is that ROE will come. It's only a matter of time.
I'm going to ask a question which in a sense I've been asking every banker. Is it the right way to look at a bank purely based on price to book, or should one look at P multiples? Because ultimately it's about growth. The whole challenge of looking at price to book is such a variable concept in this kind of an environment that you never get the clear picture. Like in your case, I can make and slice your book in many ways depending on my assumption. Rather than focusing on that, should one focus on absolute growth?
Banks raise the equity from time to time, and therefore, hence, the price to book becomes a benchmark. But even in terms of price to equity, price to book, people normally factor return on equity in the equation. That is one of the reasons Morgan Stanley goes after us every time saying that, your ROE is low. But anyway, coming back to the ROE point, they are looking at us at 2% ROE today. But they should not forget that in a previous company, we removed the ROE from negative to 15% to in fact heading towards 20. So even here, ROE will come. So to your, of course, question, I explained to you the reason why price to book is used as benchmark, but frankly, it will go either way. By the way, consumer companies, we are now consumer companies. Remember, because we are like 64% retail. In the next 2-3 years, we'll probably be 80%. Then consumer companies are valued price to earnings, and then it's a close guess to valuers.
Which was the point I was trying to derive? I mean, why should one, ultimately banks are a play on economy and consumer, then why should we look at historical benchmarks? But we'll keep that conversation for some other time.
It's also because it's corporate loans. If you take a consumer company and think of like a consumer company, you can value it like a consumer company.
No, that's a great point. I mean, ultimately, there's a corporate book which we need to be cognizant of. So let's talk about the infrastructure sector. The government is committed to spend a lot on infrastructure sector. I expect that once the bad bank and other factors would be at play, things would not incrementally, but they would dramatically change for the infrastructure sector. So the legacy problem, do you think now could in a sense be a future growth driver also? Are we looking at that kind of a scenario?
No, we're not going there at all. First of all, what the government has done on infrastructure is fantastic. And as an Indian, as a resident of this country, we obviously feel proud that someone is going after infrastructure the way this government is doing. Not just in bad bank and not just that 20,000 crores and DFI. It's also kind of investment government is putting out infrastructure is crazy. But we will have a derived advantage of all that investment. Derived advantage, meaning when money goes to the roads, ports, infrastructure, etc., that leads to, that money comes on to the vendors are contractors are employees, the whole chain and cement and steel and everything starts moving, consumption moves. So we will have a derived play of consumption. Really, infrastructure has its own challenges, and I think everybody recognizes that. We're not going there, short answer. We just want to be a fantastic consumer bank. A well-growing, good risk management, good corporate governance consumer bank.
Okay. In today's world where everything is perhaps going digital and fintech disruptions are happening, and they are particularly happening in the consumer banking and the consumer retail space, how will you differentiate yourself?
We are really at the front of that. We love it, first of all, because we know that game. We played that game for 10 years. Basically, this game can be very unnerving for those who don't know the game. But that's where we were born. We were born fintech. So, for example, we have the ability to give out, consumer loans after doing all kind of algorithm of fraud, analytics, credit bureau, everything in a matter of seconds. We know we give out close to about, we have about 3 to 4 million loans, what we can give out a year through the use of technology. So even on the liability side, we use technology to great effect. The kind of CASA we've got is also because of a technology capability, not just because of pricing. So the short answer is that, therefore, we are very good at this space, and I think we will lead on that front. By the way, we have a new app coming up, which is very, very advanced. You can have a look at that.
I look forward to experiencing that. A very basic yardstick which markets and investors use is that what is the promoter commitment to its business, which is ownership patterns. Your ownership has been gliding down. Has that been done consciously? And if you've sold, why? You're sounding excited about future. You think worst is behind, growth is back. Then why are you selling or reducing your stake?
No, actually, it had a sequence. I know what you're referring to. When it was Capital First, I gave away stock to some people because I thought they all helped build the company. Then Corona happened, and that was about 20% of my holding. Then when Corona happened, I had to sell a significant holding because of I'm not a generational wealthy guy, so I borrowed money to buy the stock. So and did a leveraged buyout of the bank of the prior company. My apologies. So I had a leverage. So in Corona, I got stuck, so I sold. Then later, I gifted some stock to some people whom I thought were very valuable in my life in the past. So it is more, I don't know. Wealth is good only when it rotates and when it keeps moving on rather than getting accumulated to one demat account. So it's got nothing to do with the commitment. My commitment is 100%. I think the bank is like 100% mine. I work like that. So no investor need to worry on that front.
Is the leverage which you took when you committed to this transaction, is that leverage on your balance sheet still there, or that leverage is over?
It's over. So unfortunately, I had to square it at that depth of Corona at 20 rupees or something. But such is the moment. But nothing. I don't have any leverage on account of those matters anymore.
You've been very honest, and I really appreciate that. It's rarity that when you ask a direct question, you get a direct and a straight response. I'm going to twist my next question completely different. While one side, there are some investors who are saying that why is Mr. Vaidyanathan reducing stake? The other set of investors, especially on social media, you said Mr. Vaidyanathan is running this bank, and this bank is going to be the turnaround one and the big one, looking at his past experiences. So for those who are getting worried, you've addressed that they should not worry about your ownership pattern changing. But for those who are excited about what you could do you think they should also temper it down?
Yeah, I mean, I'm very aware that to your question that a lot of people believe that they should put all the money in this bank because the future of the bank is doing, or at least has a good future. I would say to everybody that my honest answer would be that you should diversify. No matter how much you trust a bank on the equity front, because equity has its own ups and downs. There may be other banks who are ahead of the curve than us, who started maybe 20 years before us or 15 years, and ahead of the curve in ROA, ROE, and therefore we are catching up. So markets may have its own ups and downs. In the long run, we will be a fantastic bank, I tell you. But short answer is you should diversify, I'd say. But on the deposit side, you can be 100% assured this is a fantastic bank. Your money is like 1,000% safe. Just sleep well.
So the saving rates which you're offering, where do you think that will settle? I know folks around me who are now migrating their loans because the savings rate or the CASA given is very high. Where do you think it will eventually settle in this year?
You mean for us or for the banking system?
For you.
Now, first of all, when we started paying 7%, we were paying it across buckets. Then we paid 7% only up to 10 crores. Then we paid savings only up to 1 crore, 7%. Now we're paying 6% only. That is a peak rate. Basically, the strength of the bank, the liquidity is strong, so we reduced it. Now, going forward, if your question is, are we going to reduce it? My sense is that not in the near future. Near future meaning like we don't have any plan to reduce it for the next 5 or 6 months, I'd say. But beyond that, who knows? But as of now, at least in the short term, there's no plan to touch savings rates anymore. It's quite attractive. And we'll see how the interest rates in the Indian system move.
The big picture is that in the banking sector, consolidation is evident, consolidation is happening, consolidation is going to be an ongoing process. How do you see the landscape of the Indian banking sector changing? Will the number of banks become less, or banks will be there, it's just the relevance of small banks will be completely washed out?
Not at all. Actually, if you see whether small banks, medium banks, they are catering to specific needs. And therefore, everyone will have a space. No one bank, not State Bank of India, not any of the big four, none of them can meet all the needs of this country. Everybody has their own criteria, and let me say, product programs of respective banks are by themselves not inclusive, they're exclusive, because they exclude somebody to make a program. So what I mean, therefore, is that there will be a space for lots of small finance banks. In fact, I would personally wish that India gives out a lot more number of small finance banks which can cater to these needs. And of course, even universal banks, India needs a lot more banks. In fact, consolidation of banks is not a good solution. In fact, it should, like this government has done privatization, which I find is quite amazing.
For any consumer bank like yours, there is a very large fee-based component which comes in, whether it is the securities business, wealth management business, other aspects of fee-based income. Now in India, the fee structures are very high, which is the commissions what insurance companies are giving, the fee which mutual funds are giving. But in today's zero broking environment where fintech has disrupted everything, do you think fee-based income in general, the spreads could come under pressure?
Well, depends on how you look at it, because if your book is growing, and the business operations are increasing, fee-based incomes can keep increasing. But what we are very conscious as a bank is that, and this is a commentary made to all employees of the bank all the time, that we don't want to see any fee-based income, any fee income in the books which is made at the cost of, trying to pinch the customer's pocket in an incorrect sort of way. So therefore, we are very confident. For example, we tell our customers saying that, look, I'm giving you 3 insurance companies. You choose the best product. Don't worry about what fee income we make. So we follow it like that. But generally speaking, I feel that fee income will continue to grow because you offer more services, collecting a fee. Credit cards we're launching now, for example. That again is a line of business for us, and we'll build what we built there.
Yeah, that's a disruptive launch, isn't it? The kind of fee what you are charging, you have set cat amongst the pigeons.
Well, the intention actually was not set to, set any cat among any pigeons, but actually the way I always think of expanding markets. We just thought that, look, forever in India for 30 years, interest rates have been like 38 to 40% on credit cards or something like that. Cash withdrawal is even more expensive. So we just thought that, look, we can price customers individually based on certain algorithms and logics. And by the way, even on cash advance, the fee structure in India has been very high. When people withdraw cash, the bank treats the entire outstandings on the card, not the withdrawn cash. Entire outstanding, if you spend maybe 40,000 rupees and withdraw 5,000 rupees as cash, the entire 45,000 would become a revolver and be billed. So we thought that, look, we're a new bank. We just come straight forward and say, listen, this is we give it to you very fairly, and actually at zero, cash advance is zero for 30 odd days on the billing cycle. So I think customers are beginning to like it, like our approach towards this industry.
Well, every customer will like it if the savings account is giving higher rate of returns, and if the credit card you have to give a lower rate of returns. So that's really making a customer happy. But fantastic to have you back. You've innovated a lot of things in this sector. IDFC Bank is a turnaround story. So best wishes for a bright future and a great 2021.
Wish you a wonderful 2021, and personally yourself are really doing a wonderful job in the way incisive you are. I really appreciate you all. Thank you very much.